Hey guys, in today's video I'm going to be covering sector analysis. So far in this mini video series we've looked at the global macroeconomic level. I'm going to take it a step further and look at the next level down, which is the sector level. And I'll look at three areas in this video, looking at how different sectors perform during the economic cycle. I'll also drill into the S&P 500 and look at the sectors within that index. And I'll use an analysis tool called the SWOT analysis on how you can analyze a sector that could lead to trade ideas. I hope you find this useful. Remember to hit that subscribe button so you don't miss any future content. Thanks again for watching. Check this out. To begin with, sector analysis is an assessment of economic and financial conditions of a given sector in the economy. So if you remember in the intro to fundamentals video, we covered the top-down approach for picking stocks, which is what I've got here. Well, this is the middle of the upside down pyramid where we focus on sectors. So this area here. Now anyone that hasn't seen the intro to fundamentals video, I would recommend watching that first before going into this one, because this builds off that. I want to touch on the economic cycle because performance of different sectors in the economy will vary depending on where we are in the economic cycle. So during the peak of the economic cycle, when things are booming, you'll tend to find industrials, energy, and banks outperform, because at this point, demand for goods and services increases where people look to make big ticket purchases like cars, houses, and linked to this, credit might be freely available because unemployment is low. People are therefore able to repay loans more easily. So banks tend to do well during this period. Energy companies do well because oil consumption goes up as part of manufacturing goods and people may go on holidays more, so more oil is required. During a recession, which is defined as 2 negative quarters of GDP, causes companies to scale back as demand falls. Unemployment begins to rise. At the trough, this is where maximum pain is and people get defensive by trying to pay down debt and save. Demand continues to remain weak. Sectors that still can outperform during this period are defensive sectors like consumer staples, where people need to buy everyday goods. Pharmaceuticals also tend to do well because they tend to hold a steady cash flow and business during a downturn, as medication again is a necessity for those that require it. Once the economy is out of the trough and begins to slowly recover, this is where unemployment usually peaks. Unemployment tends to lag and recovers last in the economy. When the economy begins to recover more quickly, this is where the economy is in expansion. And growth stocks tend to do well, so areas like information technology, communication services, and consumer discretionary tend to outperform. Now the reason I'm highlighting this to you is because I believe it's important to understand the economic cycle because it can help act as a filter. So as traders, we'll focus on the sectors that are primed to outperform and avoid sectors which will lag and lead us to hold on to losing trades for a long time. That's something we don't want. So within the S&P 500, which is a major US index, there are 11 sectors within the index. Information technology is one, so companies like Microsoft and Apple. It also includes chip makers like Nvidia, to software makers to communication companies like Cisco. It has a whole variety of companies within this S&P 500 sector. Then there's materials, real estate, communication services. So this is where it's got companies like Google and Facebook, and I'll be drilling more into this sector. Then we have energy, consumer discretionary, utilities, financials, which covers banks and insurance companies. There's consumer staples, healthcare, and industrials. Now when you look at the year-to-date performance, which I've got here, it's no surprise sectors like energy and financials have outperformed. So this is the performance year-to-date of 2021, so going to end of April. Now going back to the business cycle we just looked at, I would say we are very much in the expansion phase of the cycle, where inflationary pressures push bond yields higher, which helps banks because their net interest margin increases. So the net interest margin is the difference between the rate the banks borrow versus what they lend at. Now when that increases, that increases their profits. Also, energy prices tend to rise as people go out more, particularly in this environment where countries are easing restrictions, and demand for products means more oil is used in manufacturing, so no surprise there. Let's now take a closer look at the communication services sector. So within the communication services sector, there are several subsectors such as internet content and information, which includes the likes of Google and Facebook. There's the entertainment sector, which I'll be drilling down shortly. Then there are other sectors like telecommunications, electronic gaming and multimedia, broadcasting and advertising agencies. So let's now look at the entertainment industry in more detail. So one of the great ways to analyze a sector, one area that I find useful is using a SWOT analysis, because it's a great way to map out your thought process. Now, a SWOT analysis is basically looking at strengths, weaknesses, threats and opportunities, and you can use this to analyze a company or a particular sector. So for example, a strength within the entertainment sector has been the size of the market. I mean, look at this headline. Disney launched its streaming service only last year, and now it has over 100 million subscribers. Disney Plus said at the end of its second quarter, it has 103.6 million subscribers. Netflix said last month it had almost 208 million subscribers worldwide. So it suggests this market has good growth opportunities. Now, some may look at this and say the pandemic helped create abnormal growth, which could be true. With everyone stuck indoors and not knowing how to pass time, maybe people did buy Disney Plus as a way to get through the lockdown. If this is indeed a factor, then the reopening of the economies will actually act as a threat, which means growth in subscriber numbers will actually slow because people will go out more and stay indoors less and watch less TV and streaming. If we look at opportunities, there has been quite a few deals recently. Firstly, there was the headline with AT&T and Discovery merging. Then there was this headline where Amazon has decided to join the party by buying film studio MGM, which is known for making movies like the James Bond franchise. So could this now be a threat to the other companies in the sector like Netflix, like Disney? Another thing to look at is, could the number of players increasing in the market actually be a weakness? Will it lead to more price competition and lower profits? This is the value of sector analysis, and in particular SWOT analysis. It can help map out where there may be opportunities. For example, could there be more M&A activity in this sector, as we're seeing a bunch of it right now? Could another company within this sector be targeted? These are all hypothetical questions, but with further analysis may lead to good trade ideas. So that pretty much wraps up everything I wanted to cover on sector analysis. Hopefully you've gained an insight on why sector analysis is useful and how linking it to the economic cycle can actually help determine what sectors to look at, and how you can use tools like the SWOT analysis to make better informed decisions and trade ideas. We'll be building on this now in the next video, where I'll be going into the next layer, which is company level analysis. Remember to hit that subscribe button so you don't miss any future content. Thanks again for watching. Until next time, take care folks.